Welcome back to the deep dive, where we dissect the most complex corners of the financial landscape and give you the critical, detailed insights you need to be truly well informed. Today, we are strapping in for a really intensive, quantitative deep dive into a financial product that promises, well, extraordinary returns but hides a deep structural flaw. Leveraged exchange-traded funds, or LETFs. These funds are so seductive. I mean, they offer the ability to get 2, sometimes even 3 times the daily performance of a major index. We're talking about the famous or maybe infamous ProShares Ultra Pro QQQ, you know it by its ticker, TQQQ.
That's the one.
It targets 3x the daily return of the NASDAQ 100. And on the surface, it just sounds like an irresistible shortcut to building wealth, right? Or maximizing every single upswing in the market.
It certainly looks that way.
But the devil, as it always is in finance, is really in the mechanism. We've done a massive review of the historical data, academic analysis, all the stuff surrounding these products. And our mission today is to move past the marketing and dissect exactly what happens when you hold these for longer than, say, one single trading session.
Right.
We're going to zoom in on the structural difference between these and regular ETFs, and it's a difference defined by one small but infinitely crucial word: daily.
That word daily, it's not just a piece of fine print. It's the entire mathematical engine of these instruments. A leveraged ETF is engineered very explicitly to deliver a precise multiple, in this case 3x, of the daily performance of its underlying index.
Just for that one day.
Just for that one day. And we'll be focusing our discussion today on the biggest and most widely traded examples, the ones tied to the NASDAQ 100. So that's TQQQ, which seeks that 3x daily return, and its inverse counterpart, SQQQ, which aims for next 3x the daily return. These funds are, super liquid, they're heavily traded, and crucially, they are structurally misunderstood by so many of the retail investors who end up holding them for weeks or even months at a time.
So just to be clear, if the NASDAQ is up 2% today, TQQQ is aiming for 6%.
Right.
And if it's down 1%, SQQQ is aiming for up 3%. It seems so straightforward, but like you said, that simplicity just vanishes the moment you look at cumulative performance.
It vanishes completely. The core finding, and this is confirmed by all the sources and quantitative models we looked at, is that this rigid daily objective enforces something called path-dependent returns.
Okay, path-dependent. What does that mean exactly?
It means the journey the index takes, all the volatility, the choppiness, it matters far more to the LETF's final value than where the index started and where it ended up. The structural thing, it results in a mechanism that works against the investor over time. It's universally known as volatility decay or variance drain.
Okay, let's unpack this. This is clearly a complex topic, and, understanding market volatility is really the foundation of navigating these kinds of risks. Before we really get into the mechanics of decay, just a quick but essential note. All of our analysis is based on publicly available sources. It's purely for educational purposes. We are dissecting math here, not offering trading advice.
That's right.
And for those of you who trade or invest in environments that are, defined by these extreme risks we're about to discuss, we highly recommend you monitor the broader financial health of the system. To track the total market temperature, we welcome you to search and download the iOS app Buffett Indicator from the Apple App Store. Monitoring that overall market exuberance is just paramount when you're dealing with 3x leverage. All right, so let's start with the financial plumbing. How does a fund like TQQQ manage to hold, say, $300 worth of exposure for every $100 it actually owns? I think we need to tackle that common misconception that they just, borrow money and buy more stock.
Yeah, that misconception is fatal to understanding the product. TQQQ is an ETF, yes, but it doesn't primarily hold the underlying stocks of the NASDAQ 100. If you actually look at its holdings, you'll find a portfolio that's dominated not by Apple or Microsoft shares, but by sophisticated financial derivatives.
Okay, so what instruments are doing the heavy lifting here to get that 3x exposure, and why derivatives instead of just borrowing money?
Well, the primary instruments are customized financial contracts. We're talking about swap agreements and very specific short-dated futures contracts. Using these is just vastly more efficient for getting that rapid, large-scale notional exposure.
A swap agreement. Can you break that down for us?
Sure. A swap agreement is basically a contract between the fund and a major investment bank. They're called a counterparty. The fund agrees to pay the bank a fixed rate, and in return, the bank agrees to pay the fund the daily return of the NASDAQ 100 multiplied by 3. Now, the fund does hold highly liquid assets, usually U.S. Treasury bills, which act as collateral. These T-bills are the actual assets backing the agreement, providing security to the bank. And this whole arrangement lets the fund gain this massive exposure, the notional value, without physically having to own all the underlying shares.
So that introduces a really fascinating layer of complexity and, more importantly, risk. If a traditional QQQ investor is worried about the companies in the NASDAQ, what should a TQQQ investor be worried about with this derivative structure?
They absolutely have to worry about counterparty risk. Traditional ETFs are just simple pools of assets. With TQQQ, if its counterparty, let's say it's a major global bank, were to suddenly face insolvency during a systemic crisis, TQQQ's value is directly tied to that bank's ability to actually honor the swap agreement.
Wow.
It's a risk that, everyone dismisses during bull markets, but it becomes incredibly acute during the very crises where investors might be most reliant on an inverse product like CQQ. It's a risk that is just fundamentally absent in unleveraged funds.
So these contracts are the source of the 3x exposure. But that still doesn't explain the fatal flaw. It all comes back to that daily commitment, right? The engine of path dependence, the daily reset. Let's break down the mechanical compulsion for this reset.
The reset is, it's a mathematical necessity. It's driven by the fund's mandate to maintain constant leverage relative to its changing net asset value, NAV. If the index moves, the fund's asset base changes, and the existing derivative exposure no longer equals exactly 3x.
So they have to rebalance every single day, no matter what.
Every single day. Let's run the numbers on what happens to TQQQ. Let's say it starts with $100 million in NAV and $300 million in notional exposure, so 3x.
Okay.
Scenario A, the index rises. Let's say the NASDAQ goes up 10%. TQQQ's NAV immediately jumps to $130 million.
Right, 30% gain.
Exactly. But the derivative contracts haven't changed yet, so notional exposure is still $300 million. Now you've got $300 million in exposure on a $130 million base. That's only 2.3x leverage. The fund is suddenly underleveraged.
So they're not meeting their promise to deliver 3x for the next day.
Correct. To fulfill their legal mandate, the fund manager is mathematically forced, at the end of the day during that reset, to buy more derivatives. They have to increase the exposure up to $390 million, which is 3 times $130 million.
And then that's the crucial point.
It is. They are forced to make a trade, buying more exposure after the price has already gone up.
Which means they are, by definition, buying into strength. That sounds fine in a continuous uptrend, but it's a non-discretionary buy high every single time the market closes higher.
Exactly. Now, let's consider scenario B. The index falls. The NASDAQ drops 10%. TQQQ's NAV plummets to $70 million.
A 30% loss.
Right. If the fund did nothing, that $300 million in exposure would suddenly represent 4.3x leverage. Yeah, that's wildly outside their stated mandate, and it's dangerously risky. So the fund is therefore forced to sell derivatives to bring the total notional exposure down to $210 million, which is 3 times $70 million. They have to sell exposure after the index has already dropped.
This really just underscores the self-defeating nature of it. When the market is high, they're forced to buy more, amplifying risk near the top. When the market is low, they're forced to sell, locking in a reduction of exposure right before a potential bounce.
It creates a mechanical, forced, pro-cyclical trading strategy that automatically buys high and sells low every single day the index moves. This systematic, non-discretionary behavior is the sole and unavoidable source of long-term decay.
So any extended holding period means you're just systematically subjecting your capital to this mathematically guaranteed self-destruction.
That's it in a nutshell.
We've established the mechanism then. The forced daily reset puts the fund at a perpetual long-term disadvantage. This brings us to the most crucial insight of this deep dive: volatility decay. It's a term that gets thrown around a lot, but we need to explain the mathematical physics of it.
Right. Volatility decay, or variance drain, is the structural erosion of an LETF's value over time. And it's completely indifferent to the skill of a fund manager. It is purely a function of the mathematics of compounding leverage returns on a fluctuating capital base.
So it's baked into the cake, essentially.
It's baked in. Academic research overwhelmingly confirms that the path the index takes, the amount of choppiness, the whipsawing, the volatility, that is the dominant factor in determining the long-term LETF return. It eclipses the overall direction by a huge margin.
This is where the light bulb really goes on for a lot of investors. The idea that the index can end up flat, but the leveraged product can be decimated simply because of the turbulence it went through. We have to walk through the simplest but most critical hypothetical scenario: a choppy market that ends exactly where it started.
Okay, let's do it. We use a simple 2-day example. The underlying index starts at $100 and it ends at $100.
Okay.
Day 1, the index rises 10%. So it goes from 100 to 110.
The index then falls 9.09%. That takes it from 110 right back to 100.
So our benchmark, the standard 1x index, QQQ, starts at 100, ends at 100, net return, 0.00%. Simple enough.
Now for the 3x bull fund, TQQQ. On day one, the index is up 10%, so TQQQ is up 30%. TQQQ starts at $100, and it ends day one at $130.
And crucially, the fund is now forced to buy more exposure for the next day's 3x calculation.
Exactly. So on day two, the index falls 9.09%. TQQQ must fall 3x that, which is 27.27%. And this loss is applied to the new starting value of $130.
Not the original 100.
Not the original 100. So the calculation is $130 times 1 minus 0.2727. That equals $94.55.
So TQQQ experienced a net loss of manic 5.45% over 2 days, where the underlying index went nowhere. The initial gain was on $100, but the subsequent loss was on that inflated base of 130. This is the leverage just working directly against you in a choppy market.
And that's it, exactly. The leverage amplifies the volatility. It ensures that when the market gives back the gains, the leveraged fund gives back more than the initial gain relative to where it started.
But this leads to a really common misconception. I think a lot of people who understand this might think, well, okay, if QQQ is decaying in choppy markets, the inverse fund, QQQ, must be benefiting from all that chaos, right? After all, chaos and sharp moves are what an inverse fund is designed for.
And that is a critical misunderstanding. Our analysis of the decay math shows exactly why. Let's look at the Nundakisax Bear Fund, SQQQ, in the exact same flat, choppy environment.
Okay, same 2 days.
Same 2 days. Day one, index is up 10%, so SQQQ must fall 30%. It starts at $100, ends day one at $70.
And again, crucially, the fund is forced to sell exposure, deleveraging the position for the next day's 3x calculation.
Right. So on day two, the index falls 9.09%. SQQQ must gain 3x that, or 27.27%. But this gain is calculated from that severely reduced base of $70.
Ew.
So the calculation is $70 times 1 plus 0.2727, which equals $89.09.
Wow. So SQQQ ends with a net loss of 10.91%. It lost almost twice as much as TQQQ did in the exact same flat scenario.
Okay.
Why is the inverse fund so much more susceptible to this variance drain?
It just boils down to the magnitude of that initial capital impairment. SQQQ started the volatility by losing 30% on day one, shrinking its asset base all the way down to $70. The forced daily reset meant that when the recovery swing happened on day two, the leverage was applied to a much smaller capital base.
So it's gaining a percentage of a smaller number.
Exactly. It gained 27.27% of $70, which is $19.09. TQQQ, on the other hand, lost 27.27% of $130, which was a $35 loss. The initial major loss in the short fund just severely impairs the capital, making recovery mathematically harder.
Because the gains are compounded off that dramatically smaller principal.
While the drawdowns were compounded off the original 100, this disparity confirms the really shocking conclusion. In volatile markets that end flat, both the bull and the bear leveraged funds suffer significant, sometimes disproportionate capital losses. It's all because the leverage multiplies losses off a shrinking base, and the daily reset prevents a real recovery.
That idea of path-dependent returns is really the key. I often think of it like driving. A standard ETF is like a car driving straight from point A to point B. A leveraged ETF is like a race car driver covering the same distance, but has to take 3 detours, spinning his tires in mud, constantly buying and selling equipment to keep going.
That's a perfect illustration.
The distance is the same, but the energy expenditure, the capital erosion, is massive.
The efficiency is destroyed by turbulence. It's that constant need to adjust the derivative position, which costs capital and just compounds the erosion over time.
Theory is one thing, but now we have to see how this mathematical flaw actually translates into dollars and cents across real historical market conditions. TQQQ and SQQQ launched in 2010.
Right. And the real-world data acts as an unequivocal validator of this volatility decay theory. We can isolate 4 really distinct market environments to see exactly how the funds performed.
Let's start with case study 1, the amplified bear market of 2022. This was a brutal, sustained, directional downtrend for the NASDAQ 100, a really tough year.
A very tough year. The underlying index, QQQ, lost negative 32.58%. TQQQ, the leveraged bull fund, suffered a catastrophic loss of Anarchist 80.36%.
80%. It's important to note the difference here, though. A theoretical 3x loss would have been closer to, what, minus 98%. So why did the daily reset mechanism actually prevent TQQQ from hitting that theoretical maximum loss?
Well, this illustrates the double-edged nature of the reset. In a sharp, sustained decline, the daily reset forces the fund manager to constantly sell derivatives and deleverage. They are selling low every single day, but that mechanical action prevents the leverage from amplifying the losses off the previous day's capital, which would have rapidly resulted in a total loss.
So it saves it from going to zero, but an 80% loss is still an existential crisis for a portfolio.
It is. The devastating consequence for the learner is just simple arithmetic. An 80% loss means you are sitting on only 20% of your original capital. You required a plus 400% gain just to get back to your starting point.
Oh.
It just highlights that nonlinear challenge of recovery after a leveraged loss. Meanwhile, ACE-QQQ, the inverse fund, performed exactly as designed in this strong downtrend, delivering a massive plus 82.36% gain.
Okay, now let's look at the absolute opposite. Case study 2, the perfect trending bull market of 2021. This was a smooth, low volatility uptrend, the absolute ideal scenario for TQQQ.
The dream scenario. The NASDAQ 100 gained plus 27.42%. TQQQ returned an incredible plus 82.98%.
And fascinatingly, 82.98% is slightly better than the expected 3x return of 82.26%. How do we account for that small positive difference?
This is that rare moment when the structural mechanism actually works for the investor. It's called the compounding boost. In a smooth, low volatility uptrend, that daily buy-high mechanism is consistently rewarded by the subsequent higher close.
I see.
It creates this positive compounding effect where the daily returns accumulate just a little bit faster than the simple 3x multiple would suggest. This environment high directional momentum, low volatility is the only time a long-term holding of a LETF will exceed its multiple.
But the narrative gets a lot more mixed when we look at case study 3. Volatility drag in a positive year, 2020. QQQ surged after that initial pandemic crash, finishing the year up a stunning plus 48.62%.
A huge year. But despite that powerful final rally, TQQQ returned plus 110.05%. And while that sounds fantastic, 110% is only about 2.26x the index return. It missed the 3x target by a significant margin.
So the index finished up nearly 50%. We lost almost a third of the expected leverage. Where did all that capital just vanish to?
It was consumed by the massive, sharp, and sudden volatility of the March 2020 crash. That violent whipsaw, even though it was recovered later in the year, created substantial volatility decay early on.
So the damage was already done.
The damage was done. That decay eroded the base capital and prevented the subsequent rally from achieving the full 3x compounding potential. This is powerful evidence that even in highly profitable years, volatility is the silent, constant drag on the fund's structure.
And that brings us to what might be the most definitive, mathematically pure evidence of decay. Case study 4, the definitive lose-lose scenario of 2018. This is the real-world validation of that two-day flat market example we just walked through.
It really is.
Describe the market conditions that year.
2018 was a year of extreme chop. It was defined by two major quick corrections, one in February and one in the fourth quarter. It was classic mean reversion. The index, QQQ, finished the year essentially flat, down only 1.04%. A QQQ investor basically broke even, minus fees.
Okay, so a nothing year for the index.
A nothing year. Now look at the leveraged funds. TQQQ, betting on a rise, lost negative 21.27%. SQQQ, betting on a fall, lost negative 20.74%.
That is arguably the most damning data point of them all. Two funds, structured to bet in opposite directions, both lost over 20% when the underlying asset barely moved. This should just shatter the belief that CQQQ protects you during volatility.
It absolutely should. The market was volatile, it was directionless, and it was mean reverting. The daily compounding of losses on a shrinking base and gains on a shrinking base mathematically ensure that any long-term leverage position would be impaired. If you were long, you lost over 20%.
And if you were short, you lost over 20%.
The problem wasn't the direction you picked. The problem was the structure of the fund itself. Volatility decay proved far more powerful than any directional bet that year.
The performance in 2018 and 2022 shows some really short-term pain. But TQQQ and SQQQ were only launched in 2010, which was after the two great modern crises. To really understand the existential capital-destroying risk in these products, we have to extrapolate their structure back into history. This takes us into what you call the zone of permanent impairment.
Exactly. We need to see what happens when the drawdown isn't 30%, but 50 or even 80%. So let's examine the simulated global financial crisis drawdown of 2008. QQQ fell a devastating -41.89% that year.
So what does a 3x leverage fund do when the underlying index falls nearly 42%?
Simulations indicate TQQQ would have experienced a drawdown somewhere in the range of 90% to 96%. And we should pause on that math for a second because the human human brain really struggles with the difference between a 50% loss and a 96% loss. If you lose 50% of your capital, you need a 100% gain to break even. But if you lose 96% of your capital, you only have 4% remaining. To get back to your starting point, you require a 2,400% return on what's left.
That recovery hurdle is just mathematically astronomical. So how does this impact the fund's ability to even participate in the recovery that followed?
That brings us to what's called the constant leverage trap. The fund's asset base is so decimated by the crash that it has almost no capital left. And while QQQ recovered its losses relatively quickly due to the market rally, the simulations show that TQQQ's recovery would take approximately 3 years longer than the underlying index.
3 years longer.
Because the fund has to maintain that constant leverage, it can't grow exponentially during the recovery. Its tiny residual capital base means that 3x leverage applied to a few cents on the dollar barely moves the needle. The leverage that amplified the fall becomes this insurmountable anchor during the recovery.
Okay, let's move to the ultimate stress test. The simulated dot-com crash from 2000 to 2002. The NASDAQ 100 fell over 80% from its peak over a multi-year period.
This multi-year, persistent, high-volatility downtrend is the scenario that structurally kills these LETFs. Simulations of a hypothetical TQQQ during that time show it would have been rendered functionally worthless. We're talking a loss of nearly 99%.
A 99% losses. I mean, that's just total annihilation of the capital.
Yeah.
But what happens after the crash? We know the NASDAQ 100 recovered dramatically throughout the 2010s. Did TQQQ recover with it?
And this is the detail that investors have to internalize. The backtest, starting a hypothetical TQQQ just before the peak in early 2000, found that 2 decades later, as of 2020, that TQQQ investment would still be down 70% from its initial starting value.
2 decades later, after the entire unprecedented bull run of the 2010s that saw the underlying QQQ index soar to new highs, the leveraged product never ever recovered.
That is the true definition of permanent capital impairment. The combination of the steep multi-year loss and the subsequent decay during any choppy periods meant that the capital base was just insufficient to capture the recovery effectively. The leverage created a permanent, unrecoverable hole.
So that's the difference between a normal ETF drawdown and a leveraged one.
It is. One is a temporary loss of paper value. The other is often the permanent destruction of your principal.
And finally, let's just consider a macro environment we haven't experienced recently, the cost of high rates during the 1970s simulation. This was defined by high inflation and high interest rates.
Right, the 1970s saw massive volatility combined with rising costs of capital. From 73 to 74, the NASDAQ composite plunged nearly 60%. A 3x fund would have suffered a near total loss, just like in the dot-com scenario.
But the high interest rates add another layer of problems, right?
A huge one. Remember, LETFs rely on constant borrowing through those swap agreements and futures contracts. The high cost of funding in the 1970s would have dramatically increased the fund's internal borrowing and swap costs, and that cost is passed directly to the investor, creating this constant, heavy performance drag that makes the volatility decay even worse, even when the market is stable.
So it would have been a perfect storm for structural failure.
A perfect sustained environment for it.
Okay, so we've established the mathematical flaw, which is decay, and the existential flaw, permanent impairment. But there are still significant financial drags that investors overlook. Let's delve into the disadvantages that go beyond the structural decay.
The first one, and the most visible, is the high expense ratios. TQQQ's expense ratio currently hovers around 0.82% to 0.97%, and SIQQQ is similarly high at around 0.95%.
And how does that compare to the base index ETF, QQ?
QQQ's expense ratio is typically around 0.20%. So you are paying 4 to 5 times the annual fee just for the mechanics of leverage. And while, 80 basis points might sound small, remember that this is a constant drag applied to your entire capital base every single year, regardless of market direction.
So it just accelerates the decay process.
It does. In a flat, choppy year like 2018, the investor essentially paid almost 1% in fees to lose 21% of their capital to variance strain.
And taxes are a hidden killer here, too. You mentioned they're structurally tax inefficient. Why is the daily rebalancing such a massive tax trap?
It leads to tax inefficiency because the fund managers have to constantly transact to maintain that 3x leverage. Every single time they buy or sell futures or swap contracts during the daily reset, they are realizing capital gains or losses. And because these transactions happen so frequently, these gains are almost always classified as short-term capital gains.
Which are taxed at a much higher rate.
Exactly. Short-term capital gains are typically taxed at your higher ordinary income tax rate, which can be significantly higher than the preferred long-term rate. So an investor in TQQQ might get a large tax bill full of short-term gains, even if the fund's overall performance for the year was lackluster.
So wait, how does that work?
Because the internal trading churned out gains early in the year, which were then offset by losses later. The investor gets the loss in value, but is still saddled with the taxable distribution from the earlier gains.
That is a terrible outcome. You underperform the index, and you pay higher taxes for the privilege.
It's a bad combination.
Okay, let's pivot to the one acknowledged advantage: capital efficiency. This leads us to strategic hedging versus decay, what you call the melting ice cube. When can these products be used responsibly?
They are powerful, efficient tools only for short-term tactical hedging. Imagine a fund manager with a massive long position who anticipates an earnings announcement or, say, an economic data release over the next 48 hours that might cause a sharp brief drop. They could buy SQQ to rapidly cover that notional exposure. It's highly capital efficient. They don't need to post massive margin or deal with complex futures contracts themselves. They can get 3x short exposure very quickly.
So it's a surgical tool used for a handful of days. It's not a long-term position in a portfolio.
Absolutely not. The analogy of the melting ice cube is perfect here. If that same manager holds the SQQQ hedge for several weeks or month, they expose themselves to the exact volatility decay we saw in 2018. The underlying long portfolio might be stable, but the SQQQ hedge itself could decay by 15 or 20% in a choppy market. The hedge becomes a significant capital drain.
Confirming it's tactical, not strategic, it has a very short shelf life.
A very short shelf life.
So what does this all mean? Who precisely should be using these products, given the overwhelming structural disadvantages for anyone holding them long-term?
Well, the regulatory conclusion from entities like the SEC and FINRA is definitive. LETFs are unsuitable for buy-and-hold investors. The structural risks we've detailed mean that long-term holding just fundamentally defeats the purpose of wealth accumulation.
But the products are traded so heavily. Who is the optimal responsible user?
The optimal user is a sophisticated, active, short-term trader. They are explicitly not passive investors, and this user has to satisfy several very demanding criteria.
Like what?
First, they have to possess a complete and deep understanding of the mathematics of path dependency, volatility decay, and counterparty risk. They understand the structural risks and the extreme nonlinear recovery challenge of a 90+% loss.
Okay, so they need to be an expert.
They do. Second, they must have a high-conviction directional thesis for the next 1 to 3 trading sessions only. They are playing for the daily return multiple, not the annual return.
Not a long-term view at all.
And third, and this is perhaps the most critical part, they must intend to actively monitor and manage the position on a daily, if not hourly, basis. They have to set strict limits and be ready to exit immediately if their short-term directional thesis fails. This is highly demanding, and it eliminates, the vast majority of retail participants.
So for the vast majority of people listening to this deep dive, those criteria confirm that TQQQ and SWQQQ are complex financial engineering projects designed for very specific tactical purposes, not for retirement accounts.
That is the takeaway. The complexity, the crushing expense ratios, the tax inefficiency, and the existential volatility decay risk, they far outweigh the speculative allure for any investor who's looking beyond the next 48 hours.
This has been a critical and I think extended deep dive into the hidden costs of leverage. We started with the promise of 3x returns, but we finished with the structural reality. That promise is only valid for a single trading day.
That's right.
Over any longer duration, the structure is designed to mathematically compound volatility and decay value. We saw how flat markets turned into 20% losses and how massive market crashes can lead to the permanent impairment of capital. We've looked at the evidence from the crushing, non-linear recovery needed after the 2022 losses to the simulated permanent hole created by the dot-com crash. The evidence is just overwhelming. These are high-speed trading tools with a short shelf life designed for tactical precision, not for building long-term wealth.
The analysis clearly shows that only low-volatility, high-momentum trends truly reward LETF holders over time. And given the severe, potentially permanent losses demonstrated in those historical simulations, this raises a profound question for you, the learner, to consider. Does the existence of daily reset leveraged products inherently concentrate risk in the financial system by systematically rewarding extremely short-term directional gambling while structurally penalizing the patient long-term investor? If you are operating in markets where these extreme risks are present, knowing the current macro environment and market exuberance is just non-negotiable. Again, we strongly encourage you to track the total market temperature by searching and downloading the iOS app Buffett Indicator from the Apple App Store. It provides crucial foundational knowledge before you deploy any capital, let alone leveraged capital.
Food for thought indeed. Thank you for joining us for this deep dive into the engineering of leveraged risk. We'll see you next time.